Ladies and gentlemen, good day and welcome to Escorts Kubota Ltd Q4 FY24 earnings conference call hosted by AlphaStreet Intelligence. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing the star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Mumsuk Mandalesa from AlphaStreet Intelligence Ltd. Thank you and over to you, sir.
Thank you, Steve. Good evening. On behalf of AlphaStreet Shares and Stockbrokers, I welcome you all for Escorts Kubota Ltd Q4 FY24 earnings conference call. I also take this opportunity to welcome the management team from Escorts Kubota Ltd. Today we have with us Mr. Bharat Madan, Whole-Time Director and Chief Financial Officer, Mr. Neeraj Mehra, Chief Officer, Agri Machinery Business Division, Domestic Sales, Mr. Sanjeev Bajaj, Chief Officer, Construction Equipment Business Division, Mr. Ankur Dev, Chief Officer, Railway Equipment Business Division, Mr. Sanjeev Garg, Head Finance and Tax, and Mr. Pratik Singhal, Investor Relations and ESG. We would start the call with a brief opening remarks from the management, followed by Q&A session. Before we start, I would like to add that some of the statements that company makes in today's call will be forward-looking nature and are subjected to risk as outlined in the annual report and investor releases of the company. I would request management for the opening remarks.
Thank you, Mamush. Good evening, everyone, and thank you all for joining us today. Few highlights of the company's standalone performance for the fourth quarter ended March 2024 are as follows. Operating revenue is 2,082.5 crores, down by 4.6% YOY. Tractor volume is 21,253 units, down by 14.2% YOY. Construction equipment volume 1,798 units, up by 17.7% YOY. Railway equipment revenue at 213.4 crores, down by 10.1% YOY. EBITDA for the quarter ended March 24, up by 12.8% at 265.9 crores, as against rupees 235.8 crores YOY. EBITDA margin at Q4 stands at 12.8%, up by 197 basis point YOY, mainly led by effective cost control, softening in commodity prices along with operating leverage in construction equipment division. PBT before exceptional item is 323.7 crores, up by 19.3% YOY. Net profit came at 242.1 crores, up by 30.5% YOY as against 185.5 crores. Some highlights of our standalone financial performance for the year ended March 2024 are as follows. Highest ever operating revenue at 8,776.7 crore, up by 5.2% YOY. Tractor volume at 95,858 units, down 7.2% YOY. Highest ever construction equipment volume at 6,548 units, up 41.7% YOY. Highest ever railway equipment revenue at 950.4 crores, up 12.9% YOY. Highest ever EBITDA at 1,168.8 crores, up by 49.8% YOY. Margin at 13.3%, up by 396 basis point YOY. PBT before exceptional item at 1,389.8 crore, highest ever, up by 54.0% YOY. Highest ever net profit at 1,037.2 crores, up by 70.9% YOY. Margins, PBT margins at 11.8%, up by 454 basis YOY. Capex for the year FY24 was at rupees 175 crores. Book value per share as on 31st March 24 stands at 833.8 per share. Net cash and investment as on 31st March 24 stands at more than 6,000 crores. The Board of Directors have recommended a final dividend at 180%, i.e. 18 rupees per equity share for the financial year ended 31st March 2024 as against 70%, i.e. that's 7 rupees per equity share in the previous fiscal. On a consolidated basis, company financial performance for the year ended March 2024 is as follows. Turnover up by 5% YOY at rupees 8,849.6 crore. EBITDA margin at 13.2% as against 9.2% YOY. Net profit up by 64.8% YOY at 1,049.1 crores. Fiscal year 24 has been a significant milestone in our financial performance as we achieve our best ever results on both standalone and the consolidated basis. Moving on to the segmental business performance, starting with the agri machinery business. In FY24, the total tractor industry volume, domestic plus export, decreased by 9.74 lakhs units, a 9% decline from the previous ever highest of 10.7 lakhs. Our total tractor volume saw a decrease of 7.2% to 95,858 tractors compared to 1,03,290 tractors in the previous fiscal. The domestic tractor industry in FY24 went down by 7.4% to 8,76,000 tractors, down from a record high of 9.45 lakhs in the previous year. This decline was attributed to factors such as festive shift, erratic, uneven and deficient rainfall, as well as lower water level in the reservoirs, leading to delayed crop harvest and sowing and lower output. Our domestic tractor volume saw a decrease of 5.3% to 90,239 tractors as compared to 95,266 tractors in the previous year. Despite this decline, our market share increased to 10.3% from 10.1% in the previous fiscal. Additionally, our market share for the quarter ended March 24 increased to 11.6%, a 69 basis point rise from 10.9% in the same period last year. On the export side, during the fiscal FY24, the industry was down around 21.4% to 0.98 lakh tractors as compared to 1.24 lakh tractors in the previous fiscal. Our export volume, however, went down by 30% to 5,619 tractors as against 8,024 tractors in the previous fiscal. Sales through Kubota Global Network during the year contributed more than 38% of the total export as against 30% in the last year. The segment revenue for the year ended March 2024 was at 6,110.1 crores, slightly lower than the previous year revenue of 6,316.1 crores. However, the EBITDA margin improved to 12.7%, up from 9.3% in the previous year. This increase was primarily due to more favorable product mix, better price realization, effective cost control measures, and a decrease in the commodity prices. In the first few months of the fiscal 25, we might expect a slight decrease in the domestic tractor industry due to the ongoing election, low reservoir water levels, reduced haulage activity, and a moderate Rabi output. For the full year, however, we expect the domestic tractor industry to do well and may register a lower mid-single-digit growth, led by the near to above normal monsoon this year. We are optimistic about the growth potential for our export market with Kubota Global Network and component export as we continue to expand into new markets, improve efficiency, and broaden our product portfolio. We are confident that the demand for our mechanized products will continue to grow worldwide. Coming to the construction equipment business, our serve industry of crane, backhoe loader, and compactor was up by 29% as compared to FY23, led by growth in the crane industry of 52%, backhoe loader by 23%, and the compactor industry by 42%. Our total volume of manufacturing and traded products went up by 41.7% to ever highest 6,548 machines as against 4,629 machines in the previous fiscal. Segment revenue went up by 45% at 1,709.7 crores as against 1,179 crores in the previous year. EBIT margin went up by 640 basis to 9.3% as against 2.9% in the previous fiscal. The ongoing election have temporarily impacted industry momentum, but we remain optimistic that the demand will increase following the election. The government focus on infrastructure development will support this growth. We anticipate demand to accelerate further in the fiscal year 25 as we may go forward. Coming on to the railway division, the revenue for the year ended March 24 went up by 12.9% to our ever highest yearly revenue of 950.4 crore as against 841.9 crores in the previous year. The EBIT margin for the year ended March 24 improved by 510 basis points to 18.9% compared to 13.8% in the previous fiscal. driven by a more favorable product mix, showcasing our commitment to enhance profitability and financial performance. Division launched 3 new products in FY24, which include electric control panels and brake pad for Metro coach and damper for Vande Bharat coach. Electrical control panel is a new product category and was supplied for the first time in the last fiscal. At the end of March 24, the division order book stood at a robust level of approximately 950 odd crores. By maintaining a steady, fast commitment to product diversification and expansion into new export markets, we anticipate that the railway equipment business segment will sustain its double-digit growth trajectory throughout the fiscal year 25. Now I will request the moderator to open the floor for Q&A.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handset while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Hitesh Goel from CLSA. Please go ahead.
Yeah, hello. Thanks for taking my question. Hello, can you hear me?
Yeah, Hitesh, we can hear you.
Yeah. So my question is on this construction equipment division, right? We have never seen such kind of margins in history. And this is true for not only you, but the industry also, right? We've seen a significant increase in margins in this year, right? So can you please explain what has happened? Is it product mix or there is capacity on the supply side which is helping pricing power? Can you give us more color why these margins are so high now in construction division?
Yes, I think it's a mix of all 3 factors. One, obviously, the industry has grown very well. This is the record industry this year, FY24 for the construction equipment segment, obviously largely driven by the infrastructure project, which is being pushed by the government. Second, because the cost pressure which was there earlier on the construction equipment space, obviously now commodity prices have softened, and most of those cost increases were passed on to the market. So that means the relations in the product category have been much better, and the commodity prices continue to now remain soft compared to what we've seen in the last 5-6 quarters. So that impact has been fully passed on. Even the impact of the initial emission changes which happened in this segment about a year and a half ago, that has also been passed on fully and absorbed by the market. So FY23 actually has seen a decline because of all these factors, but FY24 saw a certain good pickup. So that's why I think combination of all these factors now is leading to good mix and better realizations and obviously the better margin across the industry.
Just to follow up there, so previously there were a lot of imports from China because which was impacting the margins as well, right? So there has been reduction in imports or some policy has come through because of which domestic industry is making good margins.
Sanjeev, you want to respond?
Sanjeev is not connected. He had got disconnected.
Okay, maybe Sanjeev got disconnected now. So we're not really seeing. So China's import more on the high-end segment, especially when we are dealing with this higher RT cranes and this larger cranes. Where major imports are happening from China. So in the pick and carry segment, which is our main category, there we not seen the impact coming from the Chinese players right now. So that impact hasn't been there. It's more on the earth moving side, where we are not very large player as of now. So our market share is only about 1 to 2% range. So that's not really a significant impact for us. The pick and carry segment, if you look at the overall industry segmentation, has seen the maximum growth within the construction equipment space this year. That's where I think the benefit has been coming to us and the competition in this industry.
Good. Thanks, Bharat.
Thank you. The next question is from the line of Gunjan P. from Bank of America. Please go ahead.
Yeah, hi. Thanks, team, for taking my question. I had 2 questions. Firstly, on the industry guidance, of low to mid-single-digit growth, and also calling out first half will be slightly negative. I just want to understand what is it that we're seeing on the ground that gives us confidence that second half can actually sort of translate into 10% plus growth. I mean, to get to low to mid-single digit, we would need double-digit growth in second half. So if anything you can share in terms of, on ground that you're picking up, which gives us the confidence on this growth guide for fiscal 25.
So hi, good evening, Gunjan. This is Neeraj this side. Primarily, see, it's a bit premature to give guidance for the entire year at this point of time. The industry at now is a bit subdued, owing to the various factors that have been shared in the opening comments. But the positive part is that the forecast or the guidance for the rainfall is pretty good. It's positive. The 2 or 3 agencies which give this guidance, they have given a very positive outlook to this thing. So the first quarter will be subdued. We feel that the industry might pick up post August, September onwards.
Okay. So basically the guide is more hinging on the fact that there will be normal monsoons or better than normal monsoons. At this point of time, you are not gauging any bottoming out of sentiment in terms of tractor purchases.
Yes, the primary reason is the positive outlook on the rainfalls. Also, we are not on a low base. If you look at the last 4-5 year industry base, 875 for last year was a decent enough base. So we do not see any bottoming out per se as of now.
Okay, and there's no channel inventory issue, right? I mean, is there anything to call out that channel inventory is above normal because the festive didn't go that as well as the industry anticipated?
So the channel issues primarily from EKL's perspective are well in control. Our channels are, from our perspective, probably lower than what the industry levels are.
And can you quantify that? Like where would industry be or you be?
So I can quantify for myself. Our stock levels or inventory levels are at a level of between 37 to 39 days.
Okay. Got it. The second question I have is on the margins. I mean, the quarter-on-quarter contraction that I see in the agri machinery segment seems a bit steep. Like, I do see the volume decline quarter-on-quarter, but still, just operating leverage by itself, I feel will not probably explain the downtick. So anything else that's reflected in terms of the EBIT margin and agri machinery? And if you can also share thoughts on how we should be thinking about fiscal 25 margins, are there any levers to keep in mind? There was a price hike which was announced recently. So, some of those, moving parts on the margins.
So, Gunjan, essentially this was the operating leverage impact only. The volume drop has been significant, and also there's some production drop, because of which some variances come into play with the overhead absorption in this quarter. But going forward, we don't expect any major issue. If you look at the full year margins for tractor business also, which has been closer to 13%. So we expect, I think the margin should be actually recovering slightly from this level, and we should be able to be in 13 to 14% range, which has been the range we've been guiding now for this business for the full year basis.
And what led to the price hike, Bharat, in terms, is there any cost pressure that we're seeing?
So there's some inflation which we saw last quarter. So there's also some increase in obviously the overhead costs. So the earlier inflation has been fully passed on to the market, and there's also a reaction which was visible in the market from the competition. So obviously we have been following the competition on that front. So which is why we also take a minor hike. So it's not a significant increase. So it's a very small nominal increase has been taken, from 1st of May, which will actually take care of your overheads, increases which we project for next year.
Okay, got it. Thank you so much. I'll join back with you.
Thank you. The next question is from the line of Mr. Mumuksh Mandalesha from Anand Rathi Share and Stock Brokers. Please go ahead.
Thank you, Steve. So just want to check, we are setting up a large plant in Rajasthan. So can you share some plans for this new plant? What would be the investment size? What kind of capacity we are seeing? And how do you see the ramp up of that plant? And also, we had guided about 40 billion rupees of capex for the whole vision plan. So will that number also change because of the larger plant we are thinking about?
Yes, so we are actually still in discussion with the state government for acquisition of land. So we are in the process of given the expression of interest to them, even though the deal has not been concluded with them. We are still negotiating on the fiscal incentives that the state can offer to us. So only after the land acquisition gets completed, I think we'll getting more firmer, indication on the project costs. Because obviously there's an inflation. We've been talking about this for last now almost a year in shortlisting this thing. So some impact may happen. So the guidance of about 40 billion is more broader number as of now, because obviously we will build our capacities in phases. So we intend to double our tractor capacity there. We also intend to build our engine plant. We also intend to build gradually construction equipment plant in the same location. So this will happen, I think, over a period of 4 to 5 years. So overall, I think project size will be large. So, but as of now, I think we're still in the very initial phases. So hopefully in this year we should be able to complete the land acquisition, and some work will start on the construction side in this place.
Got it, sir. So can you update on the progress of the NBFC setup? And just want to understand how's the finance ability in the market. Are you seeing stress due to some weakness in the demand or the monsoon challenges?
Okay, I'll respond to the first part of the question. On the NBFC side, we had made an application to Reserve Bank of India for getting a license. We made this application sometime in March. So we are still in touch with RBI. We got some queries back from them and we responded to them. And typical time from RBI for giving a license is anywhere between 6 to 8 months. So we hope we are able to get the license within this fiscal year, and we should be able to start our operation. Meanwhile, all the back-end activities for readying our back-end IT system, everything is getting ready. So that will want to be ready by the time we get the license, so that we can start the operation well in time. I think on the second part, maybe I'll ask Girish to respond to that.
Hi. So overall, there isn't much of an issue on the retail side. What normally happens is post a peak season, financiers normally withdraw the temporary limits in terms of trade advances and all that they offer, working capital limits to the channel partners. And that is the reason there was some tightness post December for a couple of months. Also, the financiers were a little bit watchful in the states where the industries was dipping slightly. But overall, the finance issue is pretty comfortable, and we don't see any challenge on the retail finance side as we go forward.
Got it, sir. And lastly, Madan sir, can you update on the JV financial performance for FY24, sir?
So on JV, I think our consolidated results include the portion of our share, as a minority interest. So I think overall for the full year, obviously they were positive. So luckily the last quarter was good for both the JVs. Even though the full year was not as good, but the last quarter I think the activity picked up. The margins were good, I think, across both the JVs. And actually, if you look at the last quarter alone, our consolidated result would actually see an improvement in the margin if we combine the JVs. But obviously that won't be the sustainable number in the immediate quarter, because that was the peak season where the harvester sale was quite good and very, very good margin profile there. So overall, I think, like we mentioned, it will be close to roughly about 2,000 crores of top line which will get added, and initially it will be a margin dilutive, merger. So we are still in the process, and the thing is pending with NCLT. So I think as soon as we get that order, we'll make it effective. So hopefully, we are hoping we get this within this first quarter, but we're giving a finger crossed. Let's see when we get this.
Got it, sir. Thank you so much.
Thank you. The next question is from the line of Raghunandan NL from Nuvama Research. Please go ahead.
Thank you, sir, for the opportunity, and congratulations on strong FY24. So firstly to Neeraj sir, for FY25, given a positive outlook for the tractor industry, within that, how do you see the outlook for various regions? My initial checks indicate that North, Central and West regions are likely to do better and South is likely to see a decline. Would you agree with this? And would this put Escorts at a favorable position as our strong markets are expected to do better?
So, thank you for the question, Raghu. So, you are right in what you have actually shared. Yes, the South and to a certain extent the western part of the country would be under pressure from the industry perspective. Though the industry drop has been substantial last year, so the drop because of the low reservoir levels and also from the rainfall perspective might not be as steep as was in the last physical year. But yes, in comparison, North Central would be much better off.
Correct, sir. And given that these are our strong markets, we should get an advantage here. And also on the new product development in tractors, considering own efforts, Kubota support, what are the focus areas and can we expect launches in FY25? Any areas or any thoughts you can share here?
First on the industry part and our strength areas. See, yes, North has been traditionally been our strong pocket, and but over the last couple of years, we have lost market share there. So our focus remains in the North as we go forward in this physical year. Also, I had mentioned in the last call as well that our second focus actually is now West. West is a booming industry. And despite the fact that Maharashtra dropped in terms of industry, overall West industry contributed to about 20% of the total all India industry. South has declined substantially and remains at 15%. So yes, you are right. To a certain extent, it's a favorable position for us as we go forward. Coming to the product launches, yes, we have a certain series of product launches lined up during the course of the year. I believe it will not be prudent enough for me to speak early on those launches as of now. But yes, there are certain white spaces in our product line, and these launches will actually help us cover those white spaces.
Got it, sir. Thank you. To Bharat, sir. Sir, for FY25, can you share what would be your capex plan and how would you see the breakup of this capex?
See, next year our initial plan is to do about 300 crores of cash flow this year. Now this is obviously excluding the greenfield project which will come up. So that will be additional. So depending on what stage we end up, this year with on the project, it's only land acquisition or going beyond that. So that will be worried about this. But for the pure normal capex, it's roughly about 300 crores. Now most of this will be in three categories. One is on the product side. Roughly 1/3 will get spent on the product development side. 1/3 of the spend is actually on the building infrastructure in the factories. It's more on the sustainability front, both on renewable energy and rainwater harvesting, and also on the conversion of our diesel gensets to gas gensets, which is a government directive. Being in NCR, we're not allowed to use the diesel genset now, so we are gradually converting all the gensets into gas-based genset. So these will be the major categories, and then will be some capex which we earmark for construction and railway business too. So which will be the balance, capex which will happen. So broadly, this is the sort of split basically there.
And in the JV, sir, the effort is there on increasing gradually the localization part for Kubota tractors. Would there be any meaningful capex there?
So major capex is only on the product side, even in the JV right now, because the localization which has to happen is essentially for the engine, which is the major part, and that will happen along with the greenfield project. The engine line which we are setting up right now for our existing product portfolio, which is for power track and farm track, will be coming up in this year, which is also part of our capex plan for this year. Some capex will happen this year, but I think the major one will happen year after on this engine line.
What should be the land acquisition cost, sir, at Rajasthan?
Well, like I said, it's still being negotiated, but the ballpark number what we are getting is close to 400 odd crores.
Got it, sir. And sir, like on the agri exports, if you can talk about, the efforts on network management, integration with Kubota, new product development, homologation status, and do you see that by end of FY25, you'll be in a position to enter US, Brazil, any updates there?
Yeah, so there are actually products under development, and we expect by third quarter the development should get completed, and we are expecting good numbers to come from Kubota now, especially on those products which we are specifically making for them, and that should actually help us in driving the export volumes. So actually this year we'll see more growth maybe probably in the export volume side than on the domestic side.
Got it, sir. So you wouldn't see that boost in exports will go to next year. You are saying this year itself, we should see the benefits starting to flow through.
The reason being the base has gone down. If you look at our last year numbers, so we've gone down on export by almost 30%. So which is why the base is low. So even if we grow by 25-30% this year, we'll probably come back to the same level what we were in FY23. So essentially, to your question, I think yes, the major growth will actually start coming from FY26 on export number. Even the FY25 will still see the growth, and that's a percentage look very high. But given the base which has been corrected now for last year, so we don't think it will be a very significant increase. So maybe FY26 full year benefit will start flowing from there.
Got it, sir. Thank you so much. I'll come back in the queue for more questions.
Thank you. Ladies and gentlemen, in order to ensure that the management is able to address questions from all participants in the conference, please limit your questions to 2 per participant. Thank you. The next question is from the line of Jinesh Gandhi from Ambit Capital. Please go ahead.
Hi. Mr. Madan, what would be the production for the JV tractor capacity of 50,000? Would it be operating at 60-70% utilization or lower?
So in the JV we are doing 2 activities. One is their own tractors which they are making for Kubota brand, which last year was I think close to 18-20,000 tractors they made for themselves, which is only 40% utilization. Then they are also doing job work for Escorts. They are making the contract range of tractors in that factory, which essentially is the job work activity. So we'll say roughly 50% utilization this year, but going forward that number will continue to go up.
Okay. So effectively, for our India operations overall, at least for the next couple of years, we have enough capacity, 130 in Escorts and 50 in the JV. So is there a plan to push back the Rajasthan plant? I mean, even if we start work next year, it will take what, couple of years for it to come?
No, I think if you look at the capacity-wise, Escorts was at about 120,000 and 50,000 of the JV. So combined capacity is still about 170,000. So if you look at our existing number itself, Kubota has sold roughly 18-20,000 tractors last year, and we sold roughly 95,000 this year. And the year before we were at 105,000. So combined numbers will still be today about 130 odd thousand. So there's not much scope. So if you see slight industry growth and maybe some market share movement, so that capacity will not be enough. So if you have to start planning for capacity increase, with the way to start doing now, because the project will take some time. The lead time will be roughly about 3 years, for the project to go live. So where do we look at how we will end up? And if the export numbers also start going up, so that will be another issue I think which we need to address. So we think tractor capacity addition is something which will happen, and that has to happen, because this will also give us more growth going forward, even on the tractor export, because most of the tractor export from Kubota will happen from that factory. And also to prepare for any, potential increase in the industry going forward, which we should be able to address.
Sure. So Rajasthan plant effectively will come only in FY27-28.
Yeah, that's right.
Okay. And secondly, on the engine capex which is being done, so what's the kind of capex and capacity which will come up for that?
The new greenfield plant or the existing one you're saying?
Both existing and greenfield. Existing is what the capacity, and greenfield is what kind of addition are we doing?
So existing plant will take care of the requirement for our total, both the brands, PowerTrack and FarmTrack, as well as also the requirement for our engine business. So it will be roughly 150,000-160,000 capacity line, which will come up here. And then the greenfield will be more for FarmTrack and Kubota engines, which will be additional.
Okay, that is adding 50,000 or more in terms of engine capacity?
Double, because the tractor capacity being doubled, engine will also get doubled.
Got it. And that's part of that 4,500 crore capex which being talked about Rajasthan plant.
Yeah, that's right.
Got it. Great, sir. Thanks. I'll come back in queue.
Thank you. The next question is from the line of Mitul Shah from DAM Capital. Please go ahead.
Thank you for the opportunity. Sir, my question is on the tractor.
Sorry to interrupt, sir. I would request you to please use your handset while speaking.
Yeah, am I audible?
Yes, sir.
Yeah, we can hear you, Mitul.
Yeah, sir. Thank you for the opportunity. My question is on tractor growth and market share, which in earlier comments we highlighted that industry probably would be doing better on the north and central side, and we have stronger position, so we may get benefited from that in terms of market share gain. However, considering this FY24 itself, industry decline of 7.2%, north and central put together, there is a marginal growth. On the other hand, we declined despite our stronger markets growing, or there is a meaningful market share loss in those regions. So for next year, when the south base itself is very low and there is almost, it is 25% below the peak level. So when we are saying normal monsoon, south should revive more strongly, and which is a even challenging market for us. So market share maintaining itself would be a challenge. So what is our strategy to maintain that or increase?
So thank you for the question, Mitul. So I'll put some figures in perspective. Okay. So first of all, in terms of north and west, if you combine together, there has been a marginal growth in the market share. Overall, if you look at zone-wise, our highest growth in financial year 24 has been in the western part of the country. In north, if you go back a couple of years, we have been consistently dropping. And this is the year we have, to a very, very large extent, curtailed that drop. The drop is actually very, very minuscule, which has been consistently going on for the last 3 to 4 years. So from our perspective, we look at both these things from a very positive perspective. Coming to the south part, south industry at this point of time is only 15% of the total all India industry, the 4 big states combined together. So for example, if you take Tamil Nadu, Telangana and AP, industry put together is less than the industry of Gujarat for financial year 24. So even if the industry grows in south, the industry overall volumes will not be very, very substantial. So as I had mentioned in my earlier call as well, and I reiterate that point, our focus will be in the northern part of the country, where this year onwards we intend to gain. We have done a lot of corrections. The corrections are almost complete. So we see a clear-cut path for growth as we go forward in north. Plus, as we have gained in the western part of the country, our strategy is very clear on what we need to do both in Maharashtra and Gujarat. So the focus will be in 2 zones, the northern part of the country and the western part of the country.
So then on the market share side, even in case of Kubota also, market share from 3% is consistently now below 2% or around 2% since last almost 11-12 months. So any specific reason?
So Kubota primarily, the majority of their volumes are primarily from 2 states. The southern part of the country, that is Karnataka, and Maharashtra. And you already know that the drop in the southern part and Maharashtra has been substantial. So one of the key reasons of Kubota getting hit in terms of market share is primarily because of the steep drop in the industry. Yes, if the industry in Maharashtra and South grows, one of the key beneficiaries going forward will be Kubota.
Yes, sir. Thanks a lot.
Thank you. The next question is from the line of Abhishek Jain. Please go ahead.
Thanks for the opportunity. Sir, if you can give some colors on the revenue of Escorts Kubota India Private Limited and Kubota Agriculture Machinery Private Limited in FY24.
Sorry, Abhishek, can you repeat your question? We lost you in between.
Hello, are you able to hear me?
Yeah, we can hear you now. Can you repeat your question?
So, sir, can you give some color on the revenue of Escorts Kubota India Private Limited and Kubota Agriculture Machinery Private Limited in FY24?
The revenue?
Yeah.
Yeah, I mentioned in, I think, one of the earlier questions. So it's roughly around 2,000 crores, within these two JVs, which obviously post-merger will get added to our top line.
And how is the margin structure of this? As you said that there's an improvement on margin on quarter-on-quarter basis, but it is down on annual basis. So what is the current margin and what is your target for the next 2 years in this of margin expansion?
See, the combined impact of the margin for both the JVs was more or less break-even. Even though the last quarter, like you mentioned, has been good for them. So if you look at our consolidated numbers, we're showing increase in the PBT because of this minority interest, which is I think about 15 odd crores. So the last quarter, both the JVs put together did almost 40-45 crores of PBT, which is quite good, in this particular quarter. So going forward, we expect the margin will improve. That is what the purpose of the merger is also. When the integration starts happening, the cost slashes will happen. There's a lot of overlap which exists today when the separate entities are being operated. So those will be getting addressed gradually. And then the major lever, like you mentioned, was on the localization of component which today are getting imported in both these JVs. So once the localization starts happening, then you will see the major benefits start coming. So end objective is we should be able to clearly bring the margins, for these JVs up to the same level where we exist today in Escorts on a standalone basis. So that's our purpose. So that's our objective for the next 3 to 4 years. So that's why I think in the midterm business plan which you indicated, on the combined entity basis, we are looking at, maintaining the similar margin profile what exists today in Escorts Kubota.
And major localization would be both the engine parts localization through greenfield projects, right?
It's not just engine. Even the products which are getting imported today and they are getting sold in India, idea is to also localize those products. So I think there are compact tractors which we are today importing from Japan or Thailand. They will get localized gradually. So right now there are a very limited number of models we are making in the manufacturing JV. The other things we are still importing. So once that localization happens, so that will also improve the margin profile for the JVs.
Okay, sir. Thanks, sir. That's all from my side.
Thank you. The next question is from the line of Karan Sanwal from Niveshaay. Please go ahead.
Am I audible?
Yeah, we can hear you.
Yeah, thanks for the opportunity. I have a question regarding the pick and carry segment. So the pick and carry crane volume in the industry and for us have grown significantly. So I just wanted to have your outlook for it going forward, and if you could highlight the market share that we have in the segment and how are we planning to improve those market share.
Yeah, thank you, Karan. This is Sanjeev again. So this industry, of course, has done well over a small base of previous years. So this year we've seen this industry particularly growing at about 53%, and we do about 40% market share in this segment. And most of the volumes for us comes from the high-end segment of pick and carry cranes, which we believe is the future of these cranes and generally go for captive usage and generally are deployed in the larger projects. And of course, these are better margin products also. So we believe that going forward, in next few months, there might be a little bit of pressure on the industry because of the elections and slight slowdown might be visible. and also due to the monsoons. But after the monsoons, I think the demand will pick up. And so this year, the growth may not look very, very attractive because the base already is very high last year. But nevertheless, it will still be, there will be high demand as far as the end user is concerned because of the large number of projects which are announced, and the capex investment of government is again 10% higher than last year. So we believe that the demand will continue. Maybe a little delayed because of this short-term election impact. What we are doing to grow the business is we are playing very well in the segment which is the future high-end segment of the pick and carry cranes. Our customer loyalty is quite high in that segment, and we also are doing a lot of micro marketing in the various segments, project-wise as well as industry-wide, to grow our market share further. So we have been able to sustain close to 40% market share, plus minus few decimal places. But going forward, we have plans to improve it, and as the industry moves favorable towards the high-end crane, it will help us to grow market share also.
Yeah, okay. So that was very helpful. And the other question would be if you could highlight the major reasons for the degrowth in the agri equipment industry.
So the question was degrowth in the agri equipment industry?
Yeah, as a industry as a whole.
Okay. I think the same has been actually well articulated in the opening comments. I'll reiterate that. So the primary reason was erratic and deficient rainfalls in a majority of the states. Also, because of the low rainfalls, the reservoir levels were pretty less. So Rabi crop is primarily dependent on the reservoir crops and Kharif on the rainfall. So that is one key reason. Apart from that, one main reason was that the commercial activity, the commercial haulage segment and the mining segment were also, the bricklane industry were also pretty slow. So these were the two primary reasons for due to which the agri segment was a bit down.
Understood. And one last question. We have done a few channel checks and we have come to know that we have experienced any decrease in our number of distributors. If you could, confirm or reject the thing.
No. So the number of distributors or the dealers, what we call them, has not reduced.
Okay. No problem. Thank you so much. That would be from my side. All the very best.
Thank you.
Thank you. The next question is from the line of Sonal Gupta from HSBC Asset Management India. Please go ahead.
Hi. Good evening. Thanks for taking my question. Just one question from my side. Essentially on the railway equipment, right? Like we've been saying, we have a strong order book. We started the year very strongly, but then last 2 quarters we've been showing a year-on-year decline despite a good order book. So could you just highlight what exactly is happening there?
Yeah. Hi. Good evening, Sonal. This side Ankur Dev. So in the railway industry, actually based on tenders, and the supply schedules are defined by railways based on the stock availability, the production plans which they have. So obviously the order execution is as per the purchase order conditions and the schedules mentioned there. So obviously there will be some variation quarter on quarter, but if we see on full year basis, we have achieved a double-digit growth. So we are sure that this kind of variation could be there quarter on quarter, but obviously we anticipate that we will continue this growth momentum and we will continue to grow with double-digit. Thank you.
Okay. Thank you.
Thank you. The next question is from the line of Joseph George from IIFL. Please go ahead.
Thank you for the opportunity. Just one question. When we talked about the midterm plan, I think about 1.5 to 2 years back, one of the biggest levers was going to be supply of parts to Kubota Global, and that was supposed to be a very big opportunity. Can you give an update on where we stand there and how we plan to ramp up over the next 3-4 years?
So the export will start this year. So we have already put the team into place, and they are working with the suppliers on this. So the agreement are also getting signed with Kubota now on this particular aspect. So there are two parts. One is the JV is already exporting. Both the JVs are exporting right now to Kubota Group companies. So obviously post-merger, those exports will also come into the EKL books. And lastly, the direct exports from EKL will also start from this year. So the activity will start. Obviously, it will get ramped up gradually as the vendor development happens and those parts get developed in India.
Understood. Thank you.
Thank you. Reminder to all participants to please press star and 1 to ask question. The next question is from the line of Gunjan P. from Bank of America. Please go ahead.
Yeah, hi. Thanks for taking my follow-up. I just had a quick one on the farm implement business. What's the revenue on that in fiscal 24? And, we were also talking about a lot of work in terms of market development and relooking at our product portfolio. So if you can sort of share some thoughts on the business development on farm implement side.
So Gunjan, obviously this year we have seen growth in the implement business within EKL too, even though it's a very small part of the portfolio right now because we only deal essentially in cultivators or rotavators. So the major part will come from the JVs because they have larger range where they're dealing in harvesters and transplanters, where the value-wise it's a much bigger chunk. So I think on the combined business wise will still be, I think maybe 300 to 400 crores, sort of range. Even though if you look at standalone implement business for us this year, so we've done much better than last year, even on the cultivator front. And I think that's one of the growth lever for us, which will continue along the tractor business.
Okay, and what is the overall market size? Is there this shift that you're seeing happening more towards, because every tractor company, including your peers, are talking about building this business, taking it from unorganized to organized, looking at affordable launches. Is there a change that you're noticing, acceptance you're seeing on the farm implement side, more broader 3-4 year view I'm trying to understand on this part of the business?
Well, I don't have the market data right now with me. Maybe we can share that separately with the other business head who looks after this implement business. But like mentioned, the focus is obviously on integrating the channel because if you look at most of these implement manufacturers who are non-tractor OEM manufacturers, they got their own distribution setup, which is quite strong. So the tractors OEM don't have much presence into this business, even though our penetration right now I think is still about 5-6% only, in the implement space, with looking at our tractor population and what we sell in India. So that is still to grow. So still the major share remains with the non-tractor OEMs, but I think everyone is trying to increase that pie, and especially with the changes happening in the emission norms. So most of the self-propelled machines are seeing transition to the OEM space now because the engines are getting expensive, and for non-tractor OEMs it will become difficult to continue to sustain that sort of business. So we hope going forward this will become a sizable business for us, and we will also trying to expand the portfolio there. Like I said, going to the sprayers, which is another big category, and it's going to balers, etc. So expanding that category beyond what we are doing today. So overall, I think there will be a lot of focus within Kubota Group also. They got a separate vertical for the implement space. It's sizable business for them. So expect a similar story should get repeated in India too.
Okay, got it. Thank you so much.
Thank you. The next question is from the line of Abhishek Jain from AlphaStreet Advisor Private Limited. Please go ahead.
Sir, how you are looking synergy benefit to the channel of Kubota plus Escorts both, have you started to sell products of Kubota from the Escorts channel?
So, hi, this is Neeraj this side. So we have not started that yet, but we are exploring that possibility and the synergies between the channel as well as the products. So yes, that is in the pipeline, but to answer to your question directly, no, we have not yet started that.
And how much benefit you are looking in FY25? Because right now that Kubota's total market share is just 2.5 or 3%. So can we see significant volume jump post that this synergy benefit? Because that as you already said that Kubota presence is only in the 2 states majorly. So once this will be this product will be sold through the many Escort channels, can we see that volume jump would be around 35 to 40,000 in the coming year?
See, Ashish, I'll correct you a little bit. I did not say that they sell only in 2 states. I said that majority of their volumes are in 2 states. So their market share could be 2.5% on an all India basis, but in the states where they are present, their market share is higher. And in a couple of states, their market share is even higher than our 2 brands, PowerTrack and FarmTrack. So yes, when I said that there will be synergies, and answering to an earlier question as well, on how do we grow in South. So Kubota is one lever through which we can take advantage and grow in South. And similarly, Kubota, we are stronger in the northern part of the country. So similarly, Kubota brand can take that advantage in the northern part of the country. So geographical advantage in all the 3 brands will get accumulated as we go forward.
So what kind of the market share are you targeting combinedly in next 2 years because of this synergy benefit?
So it's very difficult to comment at this point of time. Once this synergy starts happening and we get some results over the next couple of quarters, it will be better to quantify at that point of time.
Okay, sir. And my last question on this component and railway and construction equipment business, what will the margin will be sustainable?
Yeah. Hi, Ankur this side. So from a railway perspective, I would like to mention that EBIT margin, what we have achieved in financial year 24, we see that in the coming period, it will be within the range of 100 basis points plus minus, considering as we will be launching new products. So there could be some impact of that, but it will be in the range of 100 basis points plus minus what we have seen in financial year 24.
And this construction equipment business?
Yeah, on construction equipment also, we see this 9.3% EBIT is sustainable, and we should be able to do similar numbers for the coming year.
Thank you, sir. And one more question, that what kind of the revenue we can assume from the component business? As you talked about around 300 crores kind of the revenue, incremental revenue will come through export. For next 2 years, what kind of the numbers we can take?
We had indicated in our midterm business plan the potential business has. Obviously, the major portion will depend on how much and how quickly the localization of the product happens in India. Because essentially, if you localize their product in India, only those components will get exported from India. Will also be a good margin profile. So the potential is huge because we are also looking at a China plus one strategy. In China, they are doing sourcing of close to $1 billion currently, for the production requirement in Japan. And they intend to shift a significant part to India, I think, as we go along. So the growth will be obviously significant. So I can't really tell you year by year how much will happen because it's more internal to us. But we already indicated the potential which is there in the midterm business plan. So I'll suggest you be guided with that.
Thank you, sir.
Thank you. The next question is from the line of Ashish Jain from Macquarie. Please go ahead.
Yes, sir. Good evening. Sir, I had two questions. Firstly, earlier in the call you spoke about expectation of tractor export volume recovery. So is it dependent on the demand in those markets, or we will be replacing some other supply source for Kubota, and hence it's fairly safe to assume that we can see strong volume recovery in 25?
Yeah, so I think it's essentially the second part. So we'll be replacing some of the product which will be sourced from India. They are facing competition from India, China, and Korea, in certain pockets, and they need the products, which are frugal and cost-effective and can compete with those product portfolios. So this is something which is what we are trying to do, and that's why for them Indian market is very important, and that's a sourcing for meeting the global requirement. On the recovery front, I think it's too early to say right now. The markets still continue to be under recession, both in US as well as in Europe. So we can't really say that will be the major driver, but I think it will be the product which are introducing to supplement their portfolio right now, to meet that competition, I think, which is what is going to drive the volume growth for us.
Right. Okay. Sir, secondly, on the farm equipment business, can you just clarify? So today, whatever, whether Kubota or Escorts is doing is all in the nature of trading, or we are also manufacturing either of these products in India?
No, so right now it's all trading. Even though we are exporting some of the component for harvesters from India through the JV, and gradually we'll localize those components and we'll also continue to export them. But I think on a food product basis, we are mostly trading in this activity or doing a contract manufacturing with a third party.
And that's true even for the JV farm equipment revenues, right?
Right, yeah.
Okay. Got it. Thank you so much.
Thank you. As there are no further questions, I would like to hand the conference over to the management for closing comments.
Thank you, ladies and gentlemen, for being present on this call. For any feedback or query, feel free to write us to at investor.relation@escortskubota.com. Thank you very much and have a good evening.
On behalf of Anand Rathi Share and Stock Brokers, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.